Thank you for joining us for this webinar today. My name is Paul Fenner. I head up the National Construction Team at BDO, which is part of our large real estate group. These are unique and unprecedented times, and our thoughts and sympathies go out to all of those that have been affected either directly or indirectly, and also to those that are on the front line as carers, helping to protect us all. Today is Captain Tom's 100th birthday. I personally wish him a happy birthday, and it just shows that one individual can make such a difference when we all collaborate and we all pull together in a time when we're low on positive stories. We've got a full packed webinar for you today. You will have hopefully already seen the agenda. There'll be a series of short presentations for 30 or so minutes, followed by a Q&A session. During these presentations, please submit your questions through the chat link, and I'll ensure that the panel will do their best to answer your questions. You can ask the questions anonymously, or you can leave your name and contact details, and we'll get back to you. Some questions will probably be more specific to your business, so it makes sense for us to come back to you with a more detailed, specific answer. We've got some excellent presenters today for you, including Mark Reynolds, the CEO of Mace, who built the Shard in the picture behind, but also Mark's role as chair of the Construction Leadership Council. Some of the topics that we'll cover are around funding, working capital management, supply chain, and tax initiatives. On our panel, we also have been fortunate enough to get Philip King, the Small Business Commissioner and host of the Prompt Payment Code. Philip will be available for the Q&A session at the end as well. So the theme of the presentations today was pretty much 1 month on after coronavirus and lockdown, and the detrimental impact it's had on the construction sector and on the health of our economy. We talk about health, and we've obviously seen financial health significantly impacts on mental health and well-being. We've got over 6,000 SME companies that employ 60% of the population. That's almost 16 million people that don't necessarily feel supported by the government. Managing the working capital and the supply chain is obviously key, and taking advantage of government's initiatives is also out there, is a great help. Many of these companies are struggling to borrow from the banks, who are treating loans commercially rather than just trying to save businesses and jobs at this time. A significant proportion of us will come out of this with less money, with more debt that has to be repaid, higher unemployment. It will probably take a long time to bounce back, in my opinion, and we're forecasting a difficult recession ahead. The construction sector itself has also been through a tough time. In the earlier weeks of the lockdown period, we saw the sector go through bad reputation and bad press and media, and as there was no clarity around what were essential sites to work on. There were even police fining contractors on the way to work. There are serious concerns over following regulations and guidance around social distancing and the safety on sites. So these are challenging times, and we see that good planning and preparedness is even more important now than ever. It's not all doom and gloom, and we have to keep our spirits high. We all have to work really hard to get our economy back. The current news looks like we're moving to the second phase of the virus now, and potentially there may be a relaxation in the lockdown. We're in a new world now, and things are going to be very different going forward. It's the new normal. Now that I've set the scene, let me introduce the first of our panel speakers. Mark Reynolds. I'm sure he's already well known in the industry to you all. Mark is the chair of the Construction Leadership Council, the CEO of Mace, one of the largest global construction companies, particularly very large in London. Mark is a key spokesman for delivering excellence in the construction sector, and personally I cannot think of anyone better to give their views on the challenges that we face in this sector in this current climate. Over to you, Mark.
Hello, I'm Mark Reynolds, Group Chief Executive of Mace. I'm also the chair of the Construction Leadership Council's Skills Workstream. Mace is an international consultancy and construction company. Pre-COVID, we employed 6,500 people, working in 45 countries, and we're forecasting revenues of nearly £2.2 billion. Less than 10 weeks ago, before the UK was really hit by the coronavirus outbreak, the construction sector was in great shape and looking forward to an exciting period of growth. However, as the pandemic reached us and the government announced the lockdown, almost all sites across the country were closed overnight, and many thousand employees across the sector were furloughed. At Mace, we closed our sites at the end of March, keeping just a handful open for essential works. Since then, we've developed robust operating plans for each of our projects, which has allowed us to reopen the majority of our sites with stringent rules in place to ensure the safety of our workforce, which is our first priority, and we observe social distancing guidelines. We've also been working with the industry partners and central government to ensure that everyone is working together effectively so that we can respond to this crisis together. I can't recall a time when the industry has collaborated so forcefully. I just hope this paves the way for a more joined up approach in the future. But to get the industry back to the levels of output that we were seeing pre-COVID-19, we are going to have to double our efforts, particularly how we collaborate. And by that I mean clients, consultants, tier 1, subcontractors and manufacturers all working in partnership to understand and share the contractual risks and losses. We've already seen up to a 90% fall in output, which is having a severe impact on the revenues of everyone in the sector. But this stage 1 shock is just the start. The greater risk is how contracts will be enforced during this time, and whether force majeure clauses will be sufficient and offer the supply chain with the support they really need. The government has been proactive by issuing PPN 0220. But the private sector clients, their investors and the lawyers are not adopting such a pragmatic and holistic approach. But the greater concern is the impact of output as a result of social distancing measures required on the remaining projects that have assumed pre-COVID levels of productivity. This is likely to delay existing projects by many months with even greater cost impact. There must be a fair and flexible approach to these issues. The productivity challenge is a time bomb that will have a fundamental structural impact on the sector's second and third tier supply chain. And these issues need to be addressed now. The supply chain doesn't have the resources to cope with the protracted disagreements and further losses. So unless there is a collaborative approach that addresses these, not just the stage 1 shock, but the project delays, we may see a seismic shift which will take many years to recover. However, amongst these challenges, there is a silver lining, and that is an opportunity. The construction and housing sector is a huge driver for activity, economic growth and jobs. It represents more than 13% of GDP and employs more people than the aviation and the automotive sector combined. From my conversation with central government, I believe we will continue to be supported and that the construction sector could become a cornerstone of the UK's economic recovery. We just need to appreciate that we're all in this together. And if we can ride out the storm by collaborating and sharing the losses, we will come through this stronger. Thank you.
Good afternoon, everybody. My name is Jenny and I'm a director in the Corporate Advisory Services team here at BDO. Today I'd like to spend a few moments talking through some of the themes that I've been gathering from conversations I've been having with clients over the last 4 to 6 weeks around cash and working capital management. As a backdrop, we're all aware that construction works on low margins and is a highly interdependent, complex supply chain. We'll also be aware that payment performance in the sector has been historically very poor, and there's a recognition that payment behaviours need to change. We can see here from BEIS's payment practice reporting that since introduction in 2017, payment periods across the sector have increased, performance has deteriorated, and perhaps the most disturbing of all is the percentage of invoices paid past their contractual due dates, which on average is 30% of invoices. And you can see from the sporadic nature of the chart that it makes it very difficult for companies to forecast their cash inflows. So while we recognise that there's been some great work done, particularly around the prompt payment code, where large UK contractors were highlighted with poor performance and have since rectified that and subsequently been reinstated to the code, there is still a recognition that there's more work to be done. I would very much encourage you to be using this data. The data is now starting to create a very clear picture of individual companies' payment performance, and this will continue to be reported upon and updated over the coming months, so it will be very powerful to build into collections processes and potentially credit risk management. If we look now at what's been happening since February, the government, being the sector's largest client, are very much setting precedent with their attitude towards cash management. As Mark mentioned, there's been an amendment to the Procurement Policy Notice PPN 0220, which states that all public and quasi-public entities need to review their supply chains and identifying where there is potential vulnerabilities to communicate to those companies that payment for works is guaranteed at least until the end of June. We've also seen some great practices in the private sector, Mace being an example of bringing payment days down considerably. There's Langer Rourke in the sector who've done something similar, and Taylor Wimpey have implemented a pull it forward scheme which allows some suppliers that have long-term relationships with Taylor Wimpey to be able to opt for advance payment on works that have yet to be complete. So some really, really powerful messages of good practices both across the public and private sector. I also wanted to touch on the Construction Leadership Council, so the CLC and the 12-strong task force that's been put in place, looking primarily at site safety, but also helping businesses to assess their eligibility for government financial relief packages and support applications for those packages. On a statement released by the CLC, there's been a strong message coming through on the need for collaboration in the sector, for companies that are cash rich not to be sitting on cash, and a recognition that companies should be doing and continuing to pay in relation to contractual agreements and not threatening to invoke penalties or other contractual clauses. So the key message is that it should be a priority of all businesses to stay in the industry for longer term gains. At BDO, we look at progression of the pandemic in businesses in 4 stages. And what I would say is that all businesses will go through each of these stages, but at different times. So react is the initial shock, and this looks at how companies safeguarded their businesses, both their people in the shutting down of sites and where possible projects, and protecting their revenues and cash flows. Companies then quite quickly moved into the resilience phase, so keeping the business going, and most companies are still in this phase currently, and it was around understanding what government financial packages were available, but also very much in the detail and short-term cash flow forecasting, so granular level detail on cash inflows and cash outflows. I've seen some great examples of short-term cash flow forecasts on a weekly, sometimes a daily basis, where cash committees have been created, so finance teams and commercial management teams have been brought together to understand what works were completed in January, February, March that were able to be billed, what receivables are outstanding, who's following up on the payments of those receivables, and also what disputes exist and how they can be resolved and who is going to be responsible for resolving those disputes. So some really good work that's been done, down to identifying who is the end client for the services that have been provided, and in the case where it is the government, the first tier client is not the government, making sure that that client is aware of the PPN 0220 so that cash is flowing through. We're now seeing some companies move into the recover. So once the resilience stage is embedded, how will we return to pre-COVID activities? And this is looking at sites opening up. This is looking at manufacturers and building materials suppliers being able to produce, to be able to supply, sites to be able to operate. So this is very much around strategic planning. So what is the strategic plan? Have we modelled that? Have we built our operations plan? And does the operations plan support it? Do we have an integrated financial forecast? Do we need to look at a funding review? So can I generate enough cash internally to be able to fund all of the different scenarios, or am I going to have to look at external source of funding for those scenarios? So a very, very detailed plan, and the key there will be agility and the ability to respond to unknowns that will inevitably arise. And then finally, and to realise, so as Mark mentioned, there is an opportunity. What will the new normal look like? So will we have new markets, new customers, new teams? What worked well previously? What didn't work so well? And look at putting best practices in place for the new normal. So summarising the past 4 to 6 weeks, a month since lockdown, I say key messages for me would be the need for openness, transparency, clear communication, collaboration, and joint contractual and financial risk, as well as detailed planning to support the next stage of the pandemic. So thank you for your time, thank you for listening, and I shall look forward to your questions.
Thanks, Jenny. Good afternoon, everyone. My name's Ollie Back. I'm a partner here at BDO's Contracting Commercial Risk Practice. And given the reliance on contracting within the construction and infrastructure sector, I thought it'd be worthwhile just spending a few minutes talking around some of the contractual and supply chain implications that we've been seeing out at clients and in the broader industry over the last month. There is a lot to cover within the time, so it will be high level, but hopefully it will give you some general pointers which will be useful for you to take away and maybe adapt to your own situation. In terms of what we'll be covering, we're going to touch on what we've been seeing people do within the last few weeks, just in terms of immediate contractual and commercial actions to get a grip on the situation. And then moving towards the more short to medium term activity around contract and supplier management and how that's adapting given the situation. And then we'll finish up with looking forward to, as we start to come out of lockdown and ramp back up and beyond, what that will mean for your contracts and the supply chain more broadly. The speed and impact of the virus has shocked everyone, and we rapidly went from a situation where people were looking to manage their supply chain exposures to China to one now where it's much more of a fundamental question of whether your business obligations are actually deliverable. So the vast majority of activity we've seen from a contracting perspective in the last month has really been around understanding what's buried within those contracts, both on your customer and your supply chain side, which might point towards your options or exposures around navigating your way through this crisis. There's a lot of content out there at the moment which jumps straight towards contractual enforcement and the development of litigation strategies around things such as force majeure. And clearly survival is paramount for all organisations, but from my perspective, they also need to come through this with their reputation and their critical third-party relationships intact. So whilst understanding your contractual exposures and obligations is incredibly important, I would urge people to just take a step back and consider the broader context prior to initiating any form of claim or procedure. We have heard cases recently where organisations have issued those contractual notices and they have not gone down well from a relationship perspective. And clearly different departments within your organisation will have a slightly different perspective on these points. And this is really where the C-suite and director level relationships between the parties is so vital in making sure that the right balance is struck through this. Under this new environment, there's also a need to slightly adapt the way that client and supplier contracts are managed. And as with many things at the moment, it's really worthwhile investing the time to communicate with those third parties so that you can really understand how this is impacting them and their business. This will have a material impact on their relationship with you, not just right now, but also into the future as well. And the more visibility and dialogue you have to help build that picture, it will help you navigate through it together rather than entrench yourself in existing contractual positions. From a governance perspective, unfortunately, the risk of business failure at the moment is higher than normal, and it's likely to carry on that way for some time. Now, as a result of this, it's really important to make sure that your supplier management functions are taking a really close look at what you perceive as your high-risk suppliers. Now, this can include anything from gathering credit rating reports on a regular basis to performing open source searches to gather any sort of intelligence which might point towards suppliers being at risk of immediate financial distress. And where companies are in financial distress, we would typically expect to see an increase in erroneous or even fraudulent charges being made from that organisation. So it's just a good idea to make sure that your internal governance is aware of this and they're adapting their monitoring processes accordingly. Looking forward, we've seen a recent IACCM survey which indicates that over half of construction firms are already re-evaluating their supply chain strategy as a result of the pandemic. And some of the areas that they're focusing on appear to be moving away from sole sources and single points of vulnerability and limiting exposure to low-cost markets around the globe. So some of the solutions include nearshoring and boosting domestic sources of supply, but they're also re-evaluating the risk and cost equation with regards to stocking and inventory levels in the event that there was a second wave to come or another pandemic down the line. Much of the media focus this week has been around exit strategy, and I suspect that government will use public infrastructure as a means to stimulate production in the short term. Having said that, the commercial and residential sectors, their ramp-ups will likely look quite different to this. There are a huge number of unknowns still out there, but ultimately a successful exit for the sector will require extensive collaboration across the supply chain and across construction firms to ensure that the timing and the extent of demand overall as we come through this crisis is managed appropriately and the sector can cope. In terms of what can be done now, I think by forging closer relationships with your clients and suppliers will better equip you to plan for your exit. So, for example, adapting the scope and schedule of client projects based upon what your supply chain is now able to deliver, whilst also balancing the key priorities of your clients will be important. There isn't a silver bullet, but remaining adaptive and open to compromise will go a long way to restoring and even enhancing reputations and relationships as we go through the crisis. I'm conscious that was a lot to cover. But we are open to questions later on, whether on this webinar or whether you'd like to submit them separately to us, and we will get back to you. But in the meantime, I'll hand over to Ross to talk about some issues and considerations around funding.
Hi, my name is Ross McDonald, and I lead the debt advisory team at BDO. And I'm just going to chat to you today around the various government loan schemes. Within the Chancellor's COVID-19 support package, there are currently 5 different schemes, namely the Coronavirus Business Interruption Scheme for SMEs, also known as CBILS, the COVID-19 Corporate Finance Facility for investment grade and investment grade equivalent companies, which are typically very large, the Coronavirus Large Business Interruption Scheme, also known as CBILS, for those businesses falling between CBILS and the COVID-19 Corporate Finance Facility. And recently, 2 new schemes have been announced that are due to launch in May. The Future Fund to support innovative UK business. This is for earlier stage businesses with insufficient profitability to access the other schemes. And finally, the Bounce Back Loan Scheme for small businesses seeking loans of up to £50,000. They'll be offered via an accelerated short form process. Given I'm limited to circa 5 minutes, I plan just to focus on CBILS and syllables today. So turning to the CBILS slide. In terms of CBILS, as of the 21st of April, only £2.8 billion worth of loans have been issued via the scheme. This low success rate is the result of a number of factors. 1, the backlog in applications. banks are managing their own portfolio issues, and at the same time they've had to set up the infrastructure to facilitate the schemes and deal with a wave of applications. One high street lender said that they received over 1,800 applications in just one day. Secondly, ineligible applications. There's been a lack of understanding regarding the eligibility criteria from applicants, but this is to do with details of the scheme being shared in a fairly haphazard manner, and also the fact that they continue to evolve. And then finally, and I see this as the key reason, is that we're asking banks to walk a tightrope between supporting clients and remaining commercial. And by remaining commercial, I guess there's two factors here. One, they're nervous not to invalidate the 80% government guarantee by overstepping what is fairly subjective eligibility criteria. For example, whether a business would have been considered viable without the impact of COVID-19. And then secondly, they also remain exposed to 20% of any loss on the loan. So the lend needs to stack up with any credit committee, as any return the banks are going to make will be insufficient to cover 20% losses. Turning to the syllables slide, where CBILS is available for companies with a turnover of up to 45 million, syllables was introduced for larger enterprises. Companies with a turnover of up to £250 million can access facilities of up to £25 million, and larger companies can access facilities of up to £50 million. Now, there has been some specific constraints or guidance around the quantum. For example, it can be no more than double the wage bill or 25% of turnover. But we understand that these factors are less of a focus for the banks, so long as the borrower can justify the ask. Now, there are many similarities between CBILS and syllables, but just given timing constraints, we're just going to focus on the key differences. One, the max term on syllables has been limited to 3 years, and this is causing concern with lenders as it creates a fairly short-term refinancing cliff. Secondly, there's no 12-month interest-free holiday for syllables, so there is slightly less incentive to use syllables if prospective borrowers can raise a normal commercial loan. And then finally, the government are charging for the syllables guarantee, unlike CBILS, and this does have pricing implications. In this instance, we're already seeing some mixed results depending on the credit strength of the prospective borrower. So the guarantee should improve pricing for potentially weaker credits, but where credit is particularly strong, so quasi or close to investment grade, then there may actually be a negative implication on pricing. So you'll note on the slide that the challenges are actually pretty similar between syllables and CBILS. We just think that they're going to be further exacerbated for syllables, and this is because the exposure to banks are that much larger, and inevitably there'll be more scrutiny on any new lend. Therefore, there is a greater need for these syllables applications to clearly demonstrate how the business meets the eligibility criteria. At the same time, we think it would be worth that application selling the credit story to help the deal team present to the credit committee. And finally, the application and the supporting business plan needs to stack up and withstand challenge. My final point here is to say that we're operating in a very fluid environment. As the government reacts to lobbying from various business groups, we expect to see further changes and improvements to the loan schemes in the coming days and weeks. Finally, I look forward to answering any questions you may have. Thank you.
Hi everyone. To kick off, it's worth briefly reflecting on just how much has changed. A couple of months ago, the conversations my colleagues and I tended to be having with clients in the construction industry were, save for the IR35 changes and HMRC supply chain inquiries, focused on much more positive matters, such as exit routes, particularly EOTs, and restructuring to mitigate commercial issues and potentially adverse tax consequences on a future exit, particularly demergers, to cash in on the positive market. Fast forward 2 months, and while some businesses are well placed to ride out the current storm and even looking to take advantage of strong balance sheets to invest, organically and acquisitively, obviously there are others that are finding the going very tough. So in the time available, I want to very briefly cover the COVID-19 tax measures and outline some other practical strategies for using the tax system to assist with issues that your businesses may currently be grappling with. Tax is one area that often gets overlooked in difficult times, but in fact it can offer a route to helping a business where other avenues can't. Now, I'm sure most of you are aware by now of the government's COVID-19 tax support measures, but by way of brief recap, the government will pay the lower of 80% of the normal monthly salary, or $2,500 per month, of employees that are furloughed under the Coronavirus Job Retention Scheme. For staff on fixed salaries, this is governed by pay as per the last pay period before the 19th of March, and for those on variable salaries, this is the greater of the salary as per the same month in 2019 and the average monthly salary for the 2019-20 tax year. Note that claims cover employers' national insurance and pension auto-enrolment contributions, so do take care with what you claim, and if you have any doubt, do feel free to come to us to check the claims for you. You can only claim once. On VAT, payments due between the 20th of March and 30th of June can be deferred until any time up to the 31st of March 2021, with no interest or penalties. If you do want to take advantage of this, no formal request is required, it applies automatically. But VAT returns must continue to be submitted as normal, and businesses that normally pay their VAT by direct debit should cancel the direct debit with their bank in case HMRC's systems attempt to automatically collect on receipt of the VAT return. Import duty and import VAT can also be deferred upon application to HMRC. Businesses can also enter into time-to-pay arrangements with HMRC whereby the taxes they owe, not just VAT, but for example PAYE, NIC and tax due under the construction industry scheme, are deferred and paid in instalments. Time to pay is not a new scheme, it's actually been around since 2008, but in the past these arrangements were only really available for businesses in desperate straits and able to clearly demonstrate as much through submission of detailed cash flow forecasts. Our experience over the last couple of months is that HMRC are generally offering time to pay arrangements to a much wider class of business with few, if any, questions asked. So if cash flow is proving problematic, do explore this, but remember it is only a deferral and the tax will ultimately be payable at some point. Finally, one that's not on this slide but was an ancillary outcome of COVID-19. Having maintained for many months that the IR35 changes would come into force from April this year as planned, COVID-19 has belatedly forced the government's hand into deferring these changes until April 2021. Now clearly a lot of businesses will have already made changes to comply with the new rules, but for those that haven't, this clearly buys additional breathing space within which to deal with them. And earlier this week, the House of Lords Economic Affairs Finance Bill Subcommittee urged the government to use the extra time to completely rethink the legislation, so do watch this space. Now, I don't want to dwell on compliance, but just a quick word. So far, there have generally been no concessions in terms of allowing returns to be filed late, but we are noticing a much more accommodating approach from HMRC. That said, HMRC requires businesses' tax affairs to be up to date in order for them to benefit from the COVID-19 support measures from the government and banks, so do try and regularise your affairs as a matter of priority if you're looking to take advantage of these schemes. Do also bear in mind that there may be cash flow benefits to expediting tax filings, as I'll come on to. So, onto some strategies that are not new, but should be considered if cash is tight, or even if it isn't. There are a lot on this slide, and there will of course be others specific to your circumstances that may not be, but in the time available I'm just going to hone in on a handful. First of all, R&D. I'm sure most people dialing in are familiar with R&D credits and are probably already claiming them, but if you're not, why not? There's a repayable credit on offer, that is cash from the government, even for loss-making businesses. If you're already claiming it, can you accelerate those claims? Have you looked outside your core engineering department for qualifying R&D activities? Have you considered diverting technical staff from otherwise stalled contracts to R&D projects? Have you ever considered benchmarking your claim against other companies? If not, get in touch. Similar to R&D in many ways, but less commonly claimed, is land remediation relief. If you're clearing up contaminated land, doing asbestos removal or dealing with Japanese knotweed, for example, do make sure you claim, as again, there's a repayable credit that means you can get additional cash in the door. What about tax losses? Can you speed up the return filings to carry current period losses back and get the repayments in your bank account earlier? Can you use forecast losses to defer payments? Can you revisit prior year allocations to optimise the position? On VAT, could your return stagger be improved? Would monthly VAT returns filings help? If you're in a net repayment position, as many construction companies are, can you submit your monthly VAT returns earlier so as to get the VAT repayments in the door earlier? Are you claiming bad debt relief? Have you considered offering share options or deferred bonuses linked to future performance or company value in exchange for pay cuts? It may, of course, be easier to manage down current wage costs if you can offer staff future rewards when the business recovers. Similarly, if you hold share options, have you thought about exercising them now while values may be depressed? You may be able to get a higher element subject to CGT when you come to sell once values have recovered, whilst the company may be able to claim a corporation tax deduction now on exercise. And then on to some slightly more radical ideas. Is there scope to put a write-down in the prior year's accounts, which you may be drawing up now, rather than waiting for 2020? There's a cash tax benefit to doing so. Could changing your accounting reference date improve your corporation tax position? For larger businesses, changes to market conditions mean that existing transfer pricing policies may be out of date now. Have you considered whether a review of them could benefit your group? It may also be possible now to treat loans to distressed subsidiaries as effectively equity, such that interest no longer needs to be charged. And more generally, have you reviewed your group structure for inefficiencies recently? Would it, for example, be worthwhile hiving up valuable assets to a new holding company to protect assets in trading companies that may currently be vulnerable? So, a few ideas there. Do get in touch if you'd like to explore them, or indeed others. The key message I want to leave you with is simply don't forget tax in all of this, as it can actually help.
Thank you to all the presenters today. Some really good and excellent ideas and thought leadership. For me, the key was collaboration, sharing experience and ideas, sharing losses, as we're all in it together. So thank you to the presenters. We now move forward to the Q&A session. Let's see what questions we can see on the chat link. Thank you all.
Started the video, so hopefully you can see us all live. On the slide, there's just a description as to what we're trying to do here. So we're looking now to invite Philip King, who's joined us for the panel. Philip, as I mentioned earlier in the intro, Philip is the Small Business Commissioner and host of the Prompt Payment Code. Philip, there's a question that's just arisen, which is, from your point of view, in respect of the small businesses, what are the key issues facing them as a result of COVID-19? Philip, if you could pick that up for us.
Yes, Paul, and hello to everybody that's listening at the moment. I think the key issues for small businesses right now are that they are facing huge challenges. Obviously, they're facing real worry and they're facing massive uncertainty about the future of their business, as we all are, of the economy. Government initiatives have been great, and we've just seen those outlined by the previous presenters, but some of those are confusing, and small businesses are worried about what they can get, how they can get, when they can get support, and so on. My concern is fundamentally around late payment, so that's the area in which I'm particularly involved. And of course, payments from suppliers are often the quickest source of cash into a business. So it's really important that businesses get control of what's due to them and try and get it. Jenny referred to payments deteriorating from the payment practices reporting over recent months, and I share her view that that's disappointing. The Build UK stats, where they produce benchmarking on the Tier 1 contractors, is interesting because that shows over the last 18 months that payment averages have dropped from 45 to 36 days, and that the percentage of invoices paid within 60 days has increased from 80 to 91. I suspect that's because they're looking at a smaller subset of the population. But that information is, for me, encouraging and endorsed by the work on that the Construction Leadership Council is doing with its charter and so on that Mark was talking us through. My team, the Small Business Commissioners team, spends its time giving advice, information to small businesses that contact us and signposts to other areas of help where we aren't able to help. We get resolved in resolving issues, collecting cash, and we've collected £6.9 million so far for small businesses. And we investigate poor practice and publish reports when we identify it. And our primary remit is to change culture. In the COVID-19 crisis, I was delighted to hear both Paul and Jenny talk about collaboration when they were speaking. For me, we are in a period when we absolutely need collaboration rather than confrontation, and businesses need to be having conversations that are open, honest, and positive. And I'll leave it there, Paul.
Thank you. That's good. I've got another question. I think this will probably be for Mark and Ollie. So, force majeure clause, how enforceable will this be? And can you guarantee that customers won't claim liquidated damages against what inevitably will be delayed work, considering the slowdown due to social distancing?
Shall I take that one, Paul? And then Mark, feel free to add. Force majeure is simple in principle, but ultimately it depends what's written within your contract. It ultimately depends on establishing what the specific wording is. I strongly advise seeking legal counsel to determine the extent of the potential exposure and then work from there. Even across the standard form contracts like NEC, FIDIC, and JCT, there's slightly different wording relating to these things and varying degrees of notification requirements and things like that. And then added on top, if you're talking about third parties involved operating across different territories, there's potentially jurisdictional law to throw into the mix there as well. So it is relatively complex, and I think as a first point, it's worthwhile just seeing what's in the contract, establishing the legal position, and then taking a view of how to actually approach that with your third parties and how to prepare yourselves. So I guess the conclusion there is, sadly there will be an uptick in disputes, and I guess it's up to everyone just to try and minimise your own exposure to the best degree possible, but also where it is feasible. Do work with your third parties to make sure that everyone comes through as unscathed as possible.
Thanks, Ollie. In terms of, I've got a few tax questions certainly coming up on the screen. So first tax question, I've been trying to get through to HMRC, but never seem to be able to get through. I'm told to send an email or contact another department. What do I need to do? Rob, any advice?
Yeah, this is a very common complaint we hear. HMRC were already the resources even before COVID-19, and it's certainly become more difficult even after, than it was before to communicate with them. If you have a customer compliance manager or CCM at HMRC, they should be your first port of call. We've seen increased engagement from them during the pandemic, and the communications tend to be very positive in terms of trying to be accommodating with businesses. The smaller businesses who don't have a CCM, though, in the course of ongoing exchanges we've had with some of the most senior people within HMRC, we've been provided with a summary of the best lines of communication for each particular matter you may want to contact them for. So if you want to get in touch with me afterwards, I can point you in the direction of the best option for your particular circumstances. There may be an email address rather than a phone number, but one of the pluses of COVID-19 is that it's forced HMRC to accept and respond to more communication by this way rather than sort of post as it used to be. So some positive coming out of this.
Thanks, Rob. Actually, there's another tax question. I'm expecting tax losses to come through. Can I simply just not pay my tax bill this year?
Yeah.
I hope that's a quick one to answer.
So my answer would be possibly. I wouldn't recommend simply not paying out of communication to HMRC to this effect, as you'll start to be chased for the prior year's liability automatically.
if it's not paid by the due date. So my recommendation would be either accelerate your current year tax filings to include a loss carryback claim if you can, so that the prior year liability is simply discharged, or get in touch with HMRC to request that the prior year liability is stood over pending the expected loss carryback claim up front. This communication standing over the liability would be easier if you're a large business customer with CTM, but still likely to be possible in the current climate for smaller businesses too. You may have to provide to the expected losses to HMRC to justify the standing over, but we're certainly seeing a more accommodating line from HMRC.
Thanks, Rob. Jenny, I think this one for you. Possibly, Phil, you could step in as well. Do you think that BASE will continue to monitor and follow up compliance of payment practice reporting, or do you think that other priorities will take a back seat going forward?
Okay, that's a good question. So BASE has spent a lot of time working on this and proactively looking at supporting companies small companies to collect cash. So there's been some great improvements made over the last kind of 12 to 18 months. I think going forward, the last time I spoke with BASE at the beginning of this month, there were no current plans to relax. So due to the report requirements, recognition of companies potentially struggling through this, and therefore they will continually review that position. But currently there is no plan to relax the reporting requirements. And I think based on the premise of what the requirements are trying to do, so support larger companies in paying their small suppliers in a fair manner, I think, if anything, focus on this will probably, over the next coming months, increase, if anything. I don't know if you have any comments, Phil.
Yes, Jenny, I think you're right. My understanding from talking to BASE colleagues is that there are no plans currently to relax the requirement, although it has been discussed. But there is a help on the portal where you submit. There is an email address for a sort of support line in relation to reporting. And I do know that if a business has got a particular problem with being able to report due to furloughed employees or whatever, if they make contact with BASE, then I think they're getting a fairly sympathetic response.
Thanks. Philip, I've got another one for you. This has come in, basically specifically addresses to you. So, Philip, I was on a webinar with Paul Scully, MP. What more powers will you be given in relation to the lack of cash flow and payment being made? Also, the government being named and shamed on this issue.
In terms of more powers, I can tell you that there is a consultation that was due to come out just before the lockdown, but clearly if government wants to get meaningful responses, now is not the time to be asking stakeholders to contribute, so it will come out at some point in the future. And that will look at proposals to extend my powers and give me other things I can do, and to I guess be more forceful in some of the things I can do. That's going to be a primary legislation changes, so that's not going to happen in the short term. I think your point around, I think the question was around government paying well, and Jenny referred to the Public Procurement Notice 2/20, which is a clear guidance from the Cabinet Office to all public procurement people that they should be paying their suppliers promptly and more quickly if they can, and should be finding ways of getting cash into the smaller suppliers as quickly as possible. And also a PPN 320, which came out, which is encouraging the use of procurement cards to make that process quicker. I'm not sure if I've answered the full question, Paul. Tell me if I've missed anything, please.
No, that's fine. I think with all of these questions, there's quite a lot of questions coming through. So what I will say is that we'll have an opportunity to respond formally. We'll give you some details to come back to you. We've got names, so we'll come back to you with more formal responses, because I think some of these questions are specific to your businesses, so I think it's right to give detailed, specific answers to those. There's a couple of others. There seem to be a lot of tax questions. Rob, are you ready again? This one's a good one. So, is there any guidance to deferred taxes when they become payable? And in particular, VAT, POE, how does the government expect these deferred payments to actually be paid? So I get a lot of clients ask me that.
Yeah, so I mean, as I commented on earlier in my section, the VAT is the one that's clear. in that the current period deferral is due by 31 March next year. For other taxes, if you're entering into a time to pay arrangement, it all depends on what you agree with the revenue. So, I can't give a definitive answer for everyone, but what we're certainly seeing is, say, a lot of the construction clients we're talking to, they're agreeing with HMRC a time to payment, and they're calling out saying, can we defer this month's PAYE liability? And HMRC are saying to them, right, that's fine, don't pay it this month, it's deferred until 30th of June, and call us again next month if you defer next month, and we'll review 30th of June whether that deadline is to be put back at that point. So anecdotal evidence sort of suggests that a really quite relaxed approach on this. But unfortunately what that means is, as to whether there'll be a hard and fast deadline when all of this deferred tax will come back to bite, apart from the VAT side of things, anything under time to pay will be what you specifically agree with HMRC.
So effectively, you've got to agree with HMRC, but could you push boundaries and push for 12 months, paying it over 12 months or 6 months? Or?
Well, absolutely, you certainly could, but I guess at the moment, given HMRC are being more flexible, why not take up the sort of opportunity that they're giving and saying, we're happy to sort of let you defer a little bit, but then, let's discuss again in sort of a couple of months, and then if we need to enter into something more formal, the existing sort of time to pay arrangements that have been around for a decade or so, a more structured arrangement at that point.
Okay.
So put it off for another day if you want to, I think is the bottom line.
Thanks, Rob. Mark, I don't know if you're back on with us and sound.
Can you hear me now?
Yes, good to hear you, Mark. Firstly, the force majeure question that came through, I don't know if you wanted to add anything to that as to, clearly liquidated damage claims could be made due to the slowdown of the workforce due to social distancing. Is there anything that is in place to prevent those liquidated damages being claimed?
Well, I think as Oliver mentioned, you've got several different categories in the in various contracts. So NEC, generally, you're okay. It tends to be the JCT, traditional form of contracts. Some lawyers have amended those to say pandemics aren't included.
Yeah.
So, and if a client wants to take, and the lawyers want to take a hard line, and someone has signed up to the contract, and legally you're going to be liable, which doesn't help. The reality is if you're asking the contractors to, force majeure only gives you relief on damages, and it doesn't give you time. It gives you time, but it doesn't give you any relief against the costs. And it's the costs are going to be the biggest impact. So I think it just needs a very pragmatic approach between clients, main contractors, and subcontractors. So they've got to share the burden equally. And that isn't just in the short term shock, as I call it. It's the time bomb of lack of production or reduced productivity because of social distancing over time. And that could be 3 times more than we currently see just in the immediate shutdown.
Okay. Is there anything the government should be doing or could be doing if we lobbied?
Well, through the Construction Leadership Council, we're trying to highlight a pragmatic approach. The government have already done something to PPN 0220. So from their contracts, they've been fair and reasonable, but it's the private sector. And the legal stance, if people want to apply the legal stance of the contract, is going to make it pretty difficult for contractors and subcontractors, and those without strong balance sheets or adequate cash flows will go into administration in 3 to 6 months' time, particularly as these contracts unfold.
Okay, so as you say, it's a time bomb. I've got one more question that's come through for you, Mark, actually. So social distancing guidelines are difficult to implement. We're having to put in canteens, shower blocks, and use teams at separate times. This is obviously increasing our costs. How can we pass these costs on? It's $1 million question, I suppose.
Well, it's all part of the contract. To go back to the contract says that these are recoverable items. and generally on an NEC, an unamended NEC contract, you'd probably get relief. But if it's a JCT traditional contract, it will be the main contractor who bears that burden of putting on additional welfare facilities. But it's a conundrum. Either you want to increase your site workforce to get your output up, or you reduce the number of workers on site. So effectively, main contractors are going to have to provide more canteens, more toilet facilities in order to get the productivity. Otherwise, they're going to be in breach of health and safety regulations.
Okay. Thank you, Mark. I've got a question for Ollie. I think this one's probably best. Have you seen technology being used to manage contracts through the pandemic? So I'm assuming more technology.
Yeah, I mean, it's an interesting question. So contract management tech has been a popular topic over the last 4 or 5 years or so. And, up until recently, the technology itself hasn't actually been particularly sophisticated. But now it's getting to the stage where, you can very quickly perform risk analysis across, large volumes of contracts, which, is very helpful in a situation like this. So, identifying your obligations and tracking them, identifying your exposures to things that we talked about, like force majeure, liquidated damages, any termination rights and things like that, is very useful, as a general thing. From memory, before we hit the crisis, only around 10% of companies across all sectors had that type of capability in place. So up until now, it's been a nice to have. But actually, a lot of the chatter in the contracting commercial management community is, actually, as we go through this, the digital transformation initiative for contracts specifically is now becoming a need to have rather than a nice to have.
Thank you. I've got a question for Rob. I could probably answer some of this as well. So it's in respect of research and development being a tool for helping funding, but why is the construction sector continually one of the lowest to uptake research and development? Clearly now it's more important than ever to get this funding in place. I'll give my take first. What I've seen is it's always been low in construction. Manufacturing has always been much higher in terms of its R&D claims. I've seen a sudden surge of claims in the construction sector and in lots of other sectors as well, primarily because they're concerned that going concern sign-off on audit reports will actually mean they can't claim R&D. So they're trying to push things through fast. And actually, a number of audit reports being signed off now by many firms, audit firms, have material uncertainty paragraphs. And I'm telling people that shouldn't interfere or affect your R&D claim. It's only if you're a non-going concern. But Rob, if you want to answer the specific point on why it's such a low uptake, that'd be good.
Well, I think it's a classic, isn't it? That just finding the time and diverting your engineers away from what they're doing at their best of actually, innovating and then getting spades in the ground and doing the work. Taking the time to just sit down and speak to an R&D specialist to get the claim done, I would suggest, is the hardest thing. But also, accounting systems capturing the costs. It can be a difficult process, and obviously it's typically finding that time. So they're the two key reasons why in the past it's been a problem. But you've got to try and claim it if you can. It's the most valuable tax relief we have in this country.
Okay, I think everyone still thinks it's men in white lab coats, and actually construction has a lot of problem solving. The whole point is it's design and build. So right from design phase through to groundworks, you get a lot of problems that you have to solve. So R&D is actually prevalent in the construction sector. I've got a couple. I'll probably limit it now to 2 last questions, and then what I'll do is we'll get the questions answered separately. And we'll send them out to you. But the last couple of questions I think we've got time for. Quick one for Ollie. This is in respect of what's your view of when raw material and labour supplies will actually start to recover? Have you got your crystal ball there, Ollie?
Yeah, I think, it's a very difficult one to answer. I think ultimately it depends on what and where we're specifically talking. So if we think about China and they're slightly ahead of Europe and the rest of the world, we've seen elements of production start to fire up in China, but actually what we're hearing is that the corresponding demand from the rest of the world is not necessarily in sync with that at the moment. And then I guess you throw in the potential for, as Europe exits the lockdown, there is a risk of a further lockdown in China or a second wave. And so the situation's incredibly fluid. But I think what this is really highlighting is the fragility of the supply chain overall. It'd be really interesting to see how all of the players in the sector adapt to that going forward. The domestic sources of supply and things like that are obvious choices. But I'm also interested to understand whether or not there's an appetite more broadly around alliances and spreading supply risk across a greater number of entities. And, that's probably one for the longer term.
Okay, thank you, Rob. Last question for Mark, actually. I'll just read this out. It's a very long question. Thank you for an interesting seminar. Perhaps a question for Mark Reynolds. Are there any large contracting firms going to come together in order to boost domestic supply chain? We're hearing stories of containers of materials being stuck on the continent, PO ferries struggling, British ships and temporarily ceasing production. How are we going to improve the situation? Sorry,
but actually, it links into the answer that Ollie's just given. So I'm just going to go back on the part of the answer that Ollie gave, and then I'll answer Julia's question. So the first part is the construction sector works as an ecosystem. I don't think anyone realises that. It relies on construction and infrastructure as 1/3, housing as another third, and repair and maintenance as the last component. Now, what's happened over the last 6 weeks is the housing companies have shut down. So the likes of Taylor Wimpey, Persimmon, Barratt's aren't opening any of their sites because they can't sell any of their products. Repair and maintenance can't work because they effectively can't go into people's homes. So you've only got 50% output from the construction and infrastructure sector. So what a lot of the manufacturers did was furlough their people. So people like Ibstock, British Gypsum, Canal, a number of major manufacturers furloughed those people, and they literally didn't do any work for 3 weeks. They've suddenly come back progressively, and we started to run out of stock of certain items. So things like plasterboard, plaster, mortar have been difficult. Basic commodities, bricks, all the brick manufacturers shut down as well. So what happened is that nothing got made for 3 weeks, and the stocks only lasted for about 7 days. So they had a shortfall. And now they're coming back. So they started coming back progressively, running production lines on. So what through the construction sector, Construction Leadership Council, the Construction Products Association, the Builders Merchants Association, and the major tier 1 contractors have all got together to look at the capacity needed in the supply chain and share information. So that's been going on for about a month, and that's resulted in British Gypsum, for example, starting their production last week, Ibstock starting their production this week. So we will certainly see a return coming back from the UK manufacturers and supply chain. Overseas, that problem started about 3 weeks ahead when a lot of the Italian manufacturers, so things like cladding materials from Italy, Austria, and China, they were affected. But China came back about 4 weeks ago. So that's just the distribution from shipment through to the UK. So as manufacturers come back on stream across the world, then those shortfalls in materials will be overcome. And yes, everyone is working together and sharing information.
Thank you, Mark. Excellent response. I think we've just got time for one more, then I'm going to close. And I feel conscious that Jenny has not had too many questions. So, Jenny, this one's for you. And Phil, if you want to step in as well afterwards. So, Jenny, talking about building resilience and moving into the recovery phase that you talked about, what should I be thinking about in relation to cash and working capital management?
Yeah, so thinking about what's happened over the past month, so lots of sites are closed down. companies have run down, their people costs, they've run down overhead. So basically, a lot of companies will be going through this from a startup point of view. So really, it's around communication, so understanding from your client base, your customer base, what their expected productivity is going to be like, because typically we use historical data and trends and complement that with forecasting to support with working cap management, but that's not going to be possible because that historical data will be pretty much void in many cases. So it's really keeping, collaborating, keeping talking to clients, customers to understand what their productivity is going to be and what impact that's going to have on the demand for your products and services, right through to continuing to forecast cash flows, continuing to report on working cap metrics to understand and make sure you're right-sizing the working capital to the growth phase or the restart phase, rather than getting excess or getting into a position where you've got excess working capital. Right through to internally communicating, make sure everyone's aware of the importance of working cap and cash to support the recovery phase.
Thanks, Jenny. Well, thank you, everyone. Thanks to all the presenters. I know there's a lot more questions on the chat link, but as I said earlier, what we'll do is we'll try and get back to them. The plan is to actually send out the recorded copy of the webinar to all those that logged on. Actually, when I looked at the numbers, we were touching over 220 odd. So I think that's really good numbers for a webinar. I'm really grateful for all of you to spend your time in joining us. So once again, I thank the presenters, particularly Mark and Philip, for joining us, but obviously our BDO guys, Jenny, Ollie, Ross and Rob. I hope you found this helpful and useful. If you didn't get the answers, don't worry, you can get hold of us. We'll give you contact details. You can always get hold of me, paul.fenner at bdo.co.uk, get that right. And I just will end on, I started the intro by talking about Captain Tom. It's nice to see that he's a Colonel Tom and he's being congratulated and had a flyover, and hopefully he'll get a knighthood, because anyone who can raise 31 million, I think it is now, is inspirational, and we learn a lot from that. So without further ado, thank you again to the presenters. Thank you for attending, and thank you for some excellent questions. Thank you. Goodbye.